Let's just go ahead and shatter the illusion right now that bonds are boring. Sure, they might not make the flashy overnight headlines, but in this explainer, we're going to absolutely demystify the 10 core types of bonds you need to know. Why? Because they are, quite literally, the fundamental driving force behind how global money actually works. In fact, you might be surprised to learn that the global bond market is actually way larger than the entire global stock market. I know, right? We spend so much time obsessing over equities and stocks, but governments, massive corporations, and central banks, they're using bonds to keep the world turning. It is a massive, massive financial ecosystem. And hey, if you need more proof that bonds are an essential part of a high-level financial toolkit, just look at Warren Buffett. He's famously utilized billions of dollars in bonds at various times in his career to build and preserve his wealth. So if we want to truly understand investing at the highest levels, we absolutely need to understand bonds. To make this simple, here is exactly what we're going to cover today. First, what exactly is a bond? Then, the safest bets, government bonds. Next, funding cities and huge corporations. After that, high-risk and specialty bonds. And finally, which bond actually fits your personal goals. All right, let's jump straight into Section 1. What exactly is a bond? Lending money simplified. At its core, a bond is really just a loan. But here's the twist. Instead of a bank doing the lending, you are the lender. You lend your money to an entity, maybe a government, maybe a massive corporation, and in return, they promise to pay you regular interest. Then, eventually, they return your original cash at maturity. It's basically the ultimate mechanism for the world's largest institutions to secure capital without giving up any ownership. Which brings us to Section 2, the safest bets. Government bonds. We're exploring the true foundation of the bond market here. So government bonds are issued by national governments. Think heavyweights like Germany, Japan, or the UK. Because they're backed by a national government's ability to just collect taxes, they're generally considered some of the safest investments on the planet. I mean, historically, developed countries have a remarkably low probability of defaulting. Within this bucket, we also have U.S. Treasury Bonds, which usually mature over a much longer timeline, like 20 to 30 years, acting as this rock-solid bedrock for highly stable, long-term portfolios. Governments also offer savings bonds. These are designed specifically for everyday folks to encourage long-term saving. It's exactly why you so often see parents or grandparents buying them for young kids. It's a highly secure, set-it-and-forget-it investment that matures by the time they reach adulthood, which is just a great way to introduce some dynamic pacing to a family's financial plan. Moving right along to Section 3, funding cities and huge corporations. This is all about building communities and businesses. Stepping just slightly up the risk ladder, we've got municipal bonds. These are issued by local cities, counties, or states, and the money from these goes directly into funding tangible local projects. We're talking building schools, fixing roads, upgrading hospitals and water systems, so you actually earn interest while actively funding your own community. Plus, and this is a huge strategic advantage, in some countries, the interest you earn on municipal bonds is entirely tax-exempt. Now, alongside cities, we have corporate bonds. Massive companies like Apple or Microsoft issue these to fund their growth instead of just going to a bank for a standard loan. But because any company, no matter how big, carries a higher risk of going bankrupt than, say, a developed nation, they have to entice you with a higher potential reward, meaning corporate bonds generally pay out higher interest rates than government bonds. However, it's important to remember that not all companies carry the exact same amount of risk. Credit rating agencies actually evaluate how likely a business is to repay its debt. Companies with massive revenues and incredibly deep pockets get high ratings, and they issue what we call investment-grade bonds. You get the peace of mind knowing the company is incredibly stable, but the trade-off is you accept slightly lower yields. All right, Section 4, high-risk and specialty bonds. These are the wild cards of the bond market. We just talked about those incredibly safe blue-chip companies. But what happens if the borrowing company is notoriously risky? What if they have a frankly terrible history of managing their debt? Well, when a company has a low credit rating, maybe because they have massive debt or wildly unpredictable earnings, they issue high-yield bonds. The market actually refers to these as junk bonds, which sounds a bit harsh, but it definitely gets the point across. Because you're taking on a very real risk that this company might just go belly up, you demand a massive interest payment to offset that danger. The golden rule of the bond market absolutely applies here. Higher yield almost always equals higher risk.
Shifting over to specialty bonds, we've got inflation-linked bonds. Look, we all know inflation slowly eats away at your purchasing power, right? Well, these bonds are explicitly designed to protect you from that. Their principal value, or sometimes the interest payments, actually adjust upwards right alongside inflation. In the US, these are famously known as TIPS. As you might guess, they become incredibly popular hedges whenever global inflation starts to spike.
Next up, zero coupon bonds. These are fascinating because unlike everything we've discussed so far, they pay absolutely zero regular yearly interest. Instead, you buy the bond on sale at a steep discount today, let's say for 800 bucks. You hold it, get no interest along the way, but when it matures years later, you get handed the full $1,000 face value. So your profit is entirely just that difference between your discounted purchase price and the final payout. Rounding out our specialty section, we have convertible bonds. These are a really unique hybrid. They start their life as just standard corporate bonds, paying you steady interest. But eventually, you get the option to convert that bond into actual shares of the company's stock. It's like having your cake and eating it too. If you buy one from a fast-growing tech startup, you get the safety of bond income right now, but if the company suddenly explodes in value, you can just swap your bond for stock and ride that massive upside. Finally, Section 5. Which bond fits your goals? Let's match this spectrum to your own portfolio. Applying all of this comes down to two things: your time horizon and your risk tolerance. Consider this your ultimate cheat sheet. If you want maximum safety so you can sleep perfectly at night, government or treasury bonds are absolutely your best bet. If you're willing to take on a bit more risk for higher income, you'll want to look toward corporate or high-yield bonds. If inflation is keeping you up at night, TIPS will protect that purchasing power. And for steady income paired with some serious equity upside, convertible bonds are the play. Basically, there is a specific bond perfectly tailored to almost any financial goal. Look, bonds might not be as glamorous as the latest AI stocks or as wildly volatile as crypto, but they are undoubtedly the crucial building blocks of the entire global financial system. Once you truly grasp bonds, you finally start to understand how money actually flows around the world. So, looking back at the whole spectrum we covered in this explainer today, I've got to ask, which type of bond surprised you the most? Think about that for a second and let that curiosity guide the very next step in your financial education.